Okay, so we're going to start off today as content looking at what we call funders requisitions or monthly draw, or as I like to call it, just a really fancy invoice that we send to either our lender, generally the construction lender on the project, could be one lender, could be multiple lenders. And it's just an invoice that shows the invoices in detail that we'd like to ask for reimbursement for. And they will look at those invoices and review them and come back to you with questions about them before they fund you. And generally speaking, it goes pretty smoothly as long as you're on a timely basis and you agree to a timetable up front, which is really important to do. You'll get paid on a timely basis. And the reason that that's important is you want to make sure you're paying your contractors and they're paying their subs on a timely basis. That's one of the primary reasons that projects can go astray in terms of timing is if the funds aren't flowing the way that they're supposed to. Generally speaking, our construction folks don't like to work for free. So as long as we're getting funding on a timely basis, usually monthly, then we're able to pay our vendors on a timely basis. So if you take a look at your handout, I want you to look at the requisition. So you got an Excel file. It's labeled Module 5, 6 in 6 Restoration Housing LP. The first tab is a sample requisition that's locked. The second tab is the exact same requisition that's unlocked. So you can mess around with it if you want and change numbers if you want. So what you want to do is just take a few minutes and take a look at your sources, which is down below the uses in this particular format. It doesn't have to be. So you want to take a look at all your sources down below and then all of your uses up above, and take a look at how the original budget compares to the final total, which is at 12/31. Then take a look at your uses and do the same thing. Anything unusual you see for uses that you want to point out, and how does the budget differ? You can absolutely use this format. This is a state format that came through one of the state agencies here in Mass. Every state will have a different format. What you want to focus on is not so much the format, but the content, because your format could look different. But I'm sure if you proposed using something like this that's at least organized for your lenders, that they would probably be happy to see that. But it's the lender that you really want to talk to make sure the format is working in the way that they'd like to see it work. But you're happy to copy and paste this and use this if you'd like to. So let's just take a few minutes. Why don't you take a look at the sources and maybe put some of your answers in the chat about what maybe your primary sources are of funding. And take a look at the budget, the original budget, and let's see where we ended up in the end.
Gail, would you like me to share that?
Yeah, that'd be great. Thank you, Scott.
All right. Getting there.
No problem. Folks should have it. Great. So if you go down to row 100, 99 or 100, Scott.
Okay. Just have to unprotect the sheet.
You know what, you could go to the editable one. Just click on the second tab.
Okay.
Okay. So if you go down to row 100. So in this format, the funding sources are on page 3 of 3. the uses are on 2 of 3, and then there's a summary on 1 of 3. But so these are all your sources. And if you take a look, you'll see that bond proceeds are both a source and a negative source. And that's because the bond proceeds are used for the construction period, and then they're repaid by a number of sources down below. So a permanent mortgage for $7,715,000. Tax credit equity coming in from the investor. I'm looking just at the first budget column, and you'll see that there's budgetary changes that happen throughout the months that you're going through this. So there's tax credit equity, federal historic tax credit, state historic tax credit, and then there was a sponsor note that came in from the nonprofit sponsor, which had to do with the acquisition of the property. So instead of paying the sponsor cash for the acquisition of the property, the sponsor took back a note. You'll see that the sponsor actually also made a replacement reserve loan. There wasn't enough funding sources to set up the replacement reserve, so the sponsor actually funded that as well. That's not typical. It can happen, but it's not typical. Usually there are enough other sources to fund the opening reserve balances. And you'll see there's also a deferred fee. So last week we talked about the, we were looking at the one stop, and we were looking at the tax credit calculation, and Scott had asked about what the difference was between total TDC and net TDC. So the difference, and I am working on a document to send out to you all with notations, but the difference between total TDC and net TDC is that net TDC does not include reserves or deferred development fee. So deferred development fee is a use, but if it's also a source, it eliminates itself. And so it ends up being net out of the total development cost. So you'll see our total sources and uses are $33,545,000. And then throughout the period of construction, so generally you're preparing this once a month. And if you look at column H, this requisition, that will be where your monthly totals go, and those pull off of a separate page that's by source. And the previous requisition column is from the previous invoice that you sent out, the year to date, or the project to date, if you will. That's a better terminology, project to date, of sources collected. And then this requisition is what you're asking to collect this period, and then requested to date is the total. This is the final requisition that would be prepared for a project once the project is completed. It's really important to go back and do this. And you're asking me, why would somebody not do this? Because when you get to the very end of a deal, sometimes all the major sources have come in, and maybe you're just using operating cash to pay final invoices. But it's really important for you to continue to track it, even if your lenders don't want you to, because this is the basis for the cost certification. So if you don't keep this up to date, it's possible that you'll miss costs when you go to do your cost certification because you won't have completed this process.
So I see that 2,805,000. This requisition ties to, in that sources tab section. It ties to these uses column H up here, which is showing us what the 2,805,000 is going to be used for.
Right. So it needs to balance, right? Your sources need to match your uses every single time. You want to check each column to make sure each column balances. Sometimes we'll have an issue with the previous requisition. We had to reissue it. Make sure you're using the final requisition from the prior period, not the interim, otherwise you'll have an issue. And so you'll see each cost, and we talked either last time or the time prior about making sure these categories are the same categories in your general ledger. And you want to make sure that these tie out to your general ledger. So we did say that different agencies have different staff that prepare this. It doesn't really matter whether it's your development staff or your accounting staff. I always argue that it be the accounting staff, because I say, after all, it's just an invoice, and why doesn't the development team just review what we're doing? And that way I can be assured that we're all tied out to the GL. But if your development staff or you have a development consultant, as Scott's pointed out, lots of folks have development consultants. If they're preparing it, you do need to make sure it reconciles to your general ledger by line item. Because time comes for the cost cert, that's what the auditors are going to ask for. They're going to ask for the general ledger. It should tie out to this requisition so that we make sure we're capturing all the costs in the proper line items. So let's go through the uses then. Scott, you want to kind of pop up to the top? So construction costs, this is your GC. Land and building, that'll be the very first thing that happens if you're acquiring the property, not if you have, you might have a land cost if you're doing new construction. You would not have a building cost, acquisition building cost, but this is the way you can tell right away that it's a rehab of an existing property. So you're purchasing land and building cost. I think those are off. I think the rows shifted one down, which is why it doesn't look like there's land. It just shifted one down. So make sure we'll shift that up. So the land cost is 3.2. The building acquisition cost was 11.6, and you have a total of 14.9 for acquisition basis. So you'll see these are the hard construction costs, and the contingency, which is generally 10% of the construction costs. That's what we use. That doesn't mean that's what everybody uses. So that's up to you and your team. But remember, I told you never requisition invoices out of that line item. You should move that budget out into the appropriate budgetary line item. So you see that's what's happened here. We had a contingency of $973,000. We moved that line item out into the categories that required additional. So I think architecture and engineering down below seemed to need quite a bit of additional boost. And so a bunch of it moved there. Some of it also moved up to the actual construction contract. That's the majority of it, up to the construction contract. So you'll see that when we were done, the budget for construction was about 10.5. So architecture and engineering, surveys and permits, owner's representative that would be out looking at the project on a weekly basis to make sure everything's going along the way it needs to. FF&E, that would not, that's our own FF&E. So that might be lobby furniture, for example, that has to go in. That's probably a good example. Geotech and environmental, if you're doing urban development, there's always environmental issues with the soil, almost always. And so if you're in a more rural setting, you might not have this line item, but for sure in an urban setting. Accounting and cost cert fees, construction loan interest. So this is the interest on the construction loan that takes place through the perm close on the loan. And then we'll talk a little bit about, I think later on, about how that gets accounted for, but this is the construction loan interest. Financing fees, those are quite expensive sometimes when you have bond dealings and bond fees. Bond fees are also quite expensive. It's very expensive to do a bond deal, particularly with legal fees involved. I think somebody estimated here in Boston, it's between $600,000 and $800,000 of additional cost if you're using tax exempt bonds. So that's usually a fairly hefty line item in your budget. Low-income housing tax credit fees that get paid to the tax credit agency in your state. Appraisal cost, inspecting engineer, title and recording. I think we're getting down to the smaller dollar items. So legal, syndication cost, that would be paid to a syndicator. If you did not have a direct investor, somebody that you work with directly, like in our case, Bank of America, you might be using a syndicator who helps you to find an investor. And so they actually earn a fee. And so there's a cost of syndication. Insurance, relocation. So in our case, we're doing occupied rehab. So we definitely had relocation costs. And if you look at that line item, it really bounced up. We, in this case, the project really did not anticipate the amount of relocation that was going to take place. The length of time that it was going to take place, I think, was what cost the most in this particular case. So that's an interesting line item to try to budget for and plan for. We did have a development consultant. And then reserves that are capitalized, replacement reserves. So capitalized reserves would be operating reserves. They might be taxes and insurance reserves, and then replacement reserves. And there's our soft cost contingency. And just like up above, you don't want to You don't want to invoice out of that line. You move that budget to where you need it. And then you'll see the developer fee and overhead. That's sometimes just one number. Sometimes it's split because they earn differently. That depends on your project and your deal. So there you have total uses, project uses.
So Gail, in your state, when you submit this requisition, you would then attach copies of all the invoices for the month that add up to this $2.8 million request?
Right. So for any one of these line items, so let's just see, I can see on the screen low-income housing tax credit fees of $36,533. Do you all see that? That we're billing for. Behind this would be, there would be another tab that lists out every single invoice that then pulls up into each one of these rows. So there would be a third page here that shows by invoice what each one of these costs is made up of, and then you have to provide each individual invoice as well. Some folks take that electronically, hopefully more nowadays. Some in our state, some of our state funding sources want a paper copy. So we send out something that's equivalent to about 2 inches thick of paper. It's a lot of invoices, a lot of pages, and off it goes to our state agencies. They're often some form of funders for us in our projects, and so they have that requirement. I'm hoping that they're going to get up to speed sometime soon, but we'll see. Maybe with COVID.
And so those vendors who submitted those bills to you are waiting to get paid, and you don't have the funds to pay them until this requisition gets paid for by whichever lending agency you've submitted it to.
Right.
So I guess there's some time constraint to where you have to get this kind of out the door and then get the money back in so you can pay the vendors so they don't have to wait so long to get paid.
Right.
But they must be used to that.
I don't know if you can freeze the titles on the top. It's possible. Yep. So so different funding sources have different time requirements, and I would see our state agencies have a window of about 4 days every month that they pay, and you become quickly attuned to exactly what that is, what those 4 days are, that you need to have your documentation to them, that they're going to look at them and then they're going to pay. If you miss that window, you're out for the month. And so maybe you have an ancillary lender that you can borrow from, or maybe from your parent company sponsor, to make sure your vendors are getting paid on a timely basis if you miss. But your best practice is to know exactly what the deadlines are for each and every one of your funders. And in that way, you'll not be hitting up your parent company for cash flow that they probably need to use otherwise. So is there anything surprising about this, or does anybody have any questions about the funding sources and the uses? I don't see anything in the chat. It's pretty linear. I mean, it's pretty logical. The percentage column is really helpful because you can start to see if you're creeping in closely to where you're going to be. Sometimes you're over a little bit. You know, if you're borrowing from the contingency line item, you're likely over in some categories and under than in others. So let's see.
There's 116% on line 21. Surveys.
Yeah.
Looks like that one went over budget.
So your lenders are going to want to know why, and that's where your development. You mean, does this document translate well to another which calculates the credits? Are you going to ask me? I just saw a portion of your chat. Hold on one second. So yes, so this is the document that I use to give to the auditors along with the general ledger to prepare the cost certification. And in the cost certification is the calculation of the credits. So, and we're going to do that exercise. We're going to have y'all look at using this requisition in module 6. We're going to use this requisition to see how these dollars migrate over to a cost certification. And how does that then become a tax credit? We're going to actually do that in Module 6 next week. So it's important to understand this requisition. And if you've been doing this every single month, you'll know this like the back of your hand. I promise you, if you're doing this every single month, you'll know what's what. And it'll be important too to understand certain of the line items. You may want to have segregated them, like we've talked about legal costs that you incur to acquire the land and building are not part of eligible basis because it doesn't have to do with constructing. So those are organizational costs, which I think, Scott, are amortized these days over 5 years or some period of time.
Yes. Yes.
Okay, so it's important for you to know what's in that legal line item. And if you've been working with these every month and you keep some separate schedules to track, you'll know what that answer is. And I told you that I try very hard to do that because nobody has more of a vested interest in making sure you maximize the credits than you do as the CFO or as the financial person. Even if you're a staff person, you know, you're working for the organization that's obtaining the tax credit proceeds, and it's in your interest to do everything that you can to maximize those credits. And remember that our auditors should be trying to audit what we're doing, not do what we're supposed to do. So if you can even take a crack at it and work with your auditor, and you can take a crack at it, I guarantee you, you'll probably have a little finer tooth pencil than your auditor will, because they're auditing the results, not necessarily preparing it all the time. So to the extent we do a good job of maintaining this requisition spreadsheet, excuse me, and we're measuring it against the GL, then that's great. You can use your GL too if you've got your budget in there and you're tracking against the categories to make sure your budget to actuals are right. That's fine too. That's an advanced tool. Not everybody has that, but that's also helpful just to make sure everything stays in the line. It doesn't take long for things to get messed up. You know, if you don't watch this over each month, it doesn't take much for something to happen. And sometimes you get refunds. You know, maybe you were overbilled by a contractor and there's a refund that comes back through. You might not have billed enough. Maybe the invoice was incorrect and you have a vendor who resubmits an invoice. So all of those things can trip you up if you're not paying attention and really monitoring this on a monthly basis. So again, even if you're not preparing it, you should be looking at this to make sure that you're ready for that cost certification. So I think that's it on the requisition. We're going to be using this quite a bit. So if you have the chance to print it out or just have it available on a second screen, that would be great.
So we're ready for another poll.
Yep. So looking at the sources, who do you think that deferred fee is listed? Why do you think the deferred fee is listed? Pardon me. Either the developer is willing to forgo this portion, or the developer is willing to be paid out of operating cash flow sometime in the future.
Do we have results?
Okay, good answer. Remember that if we looked at those, remember when we looked at the costs, we saw that the development fee was 100% included in the uses, and that the piece we thought might not be collected from all the sources was listed as a source back, so that you have a net amount. Remember that it's really important for that development fee to eventually be paid during the 10-year credit period, because if it's not, then you should never have taken low-income housing tax credits for that portion of cost. So what will happen when you get close to year 10, if that deferred development fee hasn't been paid, then generally the parent sponsor will either contribute or loan money to the general partner, and the general partner will contribute those funds into the deal. and then the deal will turn around and pay the parent sponsor the deferred development fee. So I know it sounds like a big circular effort, and it is, but it is a requirement of the IRS that that fee be paid in order for it to be eligible to be used for a tax credit. The tax credit calculation is eligible basis. So we don't want to defer that fee for both reasons. We want the cash flow and we want the credits that are associated with it.
All right, I think it's my turn now. Re-engage the slides there. There we go. So for a little while now, we're going to be talking about some fairly specific accounting rules when it comes to construction costs. I think the first thing to think about when you're trying to decide how to account for your construction activity is, are you dealing with new construction or are you dealing with an acquisition rehab situation? Because the issues can be a little bit different. For capitalizing costs, if you're in a new construction scenario, meaning you bought some raw land, or you bought, if there was a building on the land, you demolished it entirely and you're starting from a raw land situation. So we call that new construction because you're building from scratch, from the raw land. That scenario is a little bit easier because almost everything gets capitalized. From a GAAP standpoint, GAAP, again, generally accepted accounting principles, we look at what is the entity's primary activity and decide if you're primarily in the construction business and this entity is still in construction phase and it's new construction, that's the only thing that's happening is you're constructing, then almost every cost that the entity incurs, almost everyone, is going to be capitalized into that construction cost, part of the property and equipment cost. On the other hand, if you're doing an acquisition rehab deal, and that's where you're buying a pre-existing building, probably with renters already in place, and then you're doing rehab, either a rolling rehab where you're moving people in and out of various units, or doing it all at once. But either way, you've got a combination of things happening. You've got some rental activity going on in that organization, as well as some construction going on. And that makes it a little harder to decide, what should I capitalize? What should I expense? Because you have to now decide, does this cost have more to do with capitalization assets under construction, or does this cost have more to do with my rental activity that's ongoing while I'm doing construction? So that just adds another layer of complexity to things. So that makes the acquisition rehab deals a little bit more convoluted accounting wise. But anyway, the first bullet point here, either way, the good news is the direct costs of construction are all capitalized. So all of those hard costs, these are what we would call, from our point of view, these would be hard costs. The contractor, the architect, the engineer, the city fees, those permits, developer fee, all of these things are direct costs of construction. They all get capitalized into the property and equipment line. May impact more than just building. Some of it may be land related, some of it might be furniture and fixture related or site improvement related. We'll talk about the different categories later, but the first question is, do I capitalize it or do I expense it? And the answer is, if it's one of these direct costs, you're going to be capitalizing all of these types of things, because this has a useful life of many years. Buildings will last, up to 40 years. For tax purposes, maybe 27 and a half years. For GAAP, maybe 40 years. But all of these costs are going to benefit all of those future periods as long as the building's still standing. The period cost is a different concept. So this is where they're called period costs. These are things like interest, insurance, property taxes. These things are incurred over a period of time. And the treatment, capitalized versus expense, has to do with what is the nature of the entity that incurs the costs. What are they doing? What are they undertaking? So that's what I was saying earlier. If you're undertaking only construction, then the period costs would probably be capitalized into the construction cost. So all of your construction interest, all of your construction period property taxes, all of your construction period insurance, all of those types of costs would be part of the building as well, because all you're doing is constructing. So all of those costs are capitalizable. On the other hand, if it's an acquisition rehab, like I said before, you now have to decide how much of these period costs are related to the construction effort versus how much is related to the rental effort. And you're kind of splitting these costs so that you're only capitalizing the portion that really pertains to capitalized efforts, and you're expensing the portion that pertains to rental activity efforts. So that gets a little tricky. We'll talk about that in more detail, but that's the basic rule. And like I said, we're going to categorize costs into these different groupings. You know, land doesn't get depreciated at all. It's not eligible for credits at all. So, you know, the IRS takes a fairly strict view of what is land. And it's not just the original purchase price of the land. Some things like grading, some types of grading are rough grading, they call it. It's where you're like moving big mountains or hills off of your land to make it suitable for construction. Those types of costs may exist in your general contractor line item, but they're actually, from the IRS's standpoint, going to be treated as a land cost because you're really improving the land to make it suitable for building. Site improvements are things like the shrubbery and the trees and the that have a 15-year life instead of a 27.5 or 40-year life. Off-sites are improvements that are done on other people's property. Like perhaps you have new construction and you have to build traffic signals or sewer lines that are not even on your land. Those are called off-site improvements. May not even be depreciable for tax purposes. Building, self-explanatory. Furniture and equipment, these are items that are removable. Then we have amortizable costs that are going to be written off over a certain period of years, depending on the useful term of that amortization period. And then we have some costs that are expensed and the reserves we've talked about. So the next module will be a deeper dive into these different cost categories and how to allocate costs into those categories. But just make sure that you're aware that just because we're saying to capitalize it doesn't necessarily mean it's going to be basis eligible, because only the depreciable property is eligible for the tax credits. So when you're dealing with the period costs, I mentioned that you're trying to capitalize items that have to do with the construction effort. And that means that you need to know when the construction period begins, and you also need to know when the construction period ends. So how do you decide when a construction period ends? Well, we look at the certificate of occupancy. When you're dealing with new construction, you'll get your local building inspector will sign off that the building is ready to be occupied. It's safe to have people move in. And this document's called a certificate of occupancy. And that really sets the date for the end of the construction activity, because now you're able to place the building in service. You're able to start renting it out. You're able to start moving families in. So it might be a certificate of occupancy. It might also be a temporary certificate of occupancy, a TCO. That's when, yeah, you may have some more costs remaining to be completed, but the building is actually safe enough that you could move people in, even though maybe 100% of the work hasn't been done yet. So whatever's left is not really a safety issue. And there again, because you have a TCO, if you do have a TCO, the date of that document, when the building inspector signs off, the date of that determines that's the end of the construction period for capitalization of period costs and the beginning of the rental period, where we expense those period costs. So that's how new construction is handled. If you're dealing with an acquisition rehab, you probably don't have a certificate of occupancy because the building was already occupied when you bought it. So you may never take the building out of service. So you never get a certificate of occupancy to put it back into service. But the way to think about it from a GAAP standpoint anyway is, each unit may be taken out of service for a period of time. If you're lucky, you're doing them all at the same time. So you just have one out of service period that's kind of similar to a new construction scenario, where during that period of time, if it's like a couple of months where the entire building is vacant, you would treat that just like a new construction 2 months, where you're capitalizing the period costs during that construction period. But more often, the rehabs are actually done as a rolling rehab, where you're doing a few units, you move people out of those few units, and then when they're done, you move them back in, and then you start on another few units, and you kind of roll through the building, gradually rehabbing unit by unit. This makes it much more challenging to decide when is your construction periods beginning and ending. But the way I think about it is each unit really has its own mini construction period. And so if you break it down that way, logically, you can think about if each unit was out of service for 2 months, even though those 2 months were rolling throughout the year, and the process started in January and didn't finish till December, but no unit was out of service for more than 2 months, then you can conclude that your construction period was probably about 2 months for the entire project. And so it would make sense to capitalize for GAAP purposes, for book purposes. It would make sense to capitalize about 2 months of period costs, because each unit on average was out of service for about 2 months. Well, the tax rules are different. And because of cost certifications and eligible basis and tax credits, you're probably more interested in tax rules than GAAP rules. Although you want to keep the books probably on the GAAP basis, but you want to be able to convert that to tax, or at least have information so that your CPAs can convert that to tax for purposes of doing a cost cert and establishing eligible basis. So, for tax purposes, we're able to make an election. It's called the 266 election, which is mentioned here on the slide at the bottom. But it allows us to start capitalizing period costs when the rehab period begins on the very first unit, and continue capitalizing, in particular interest, that's the big one, all the way until the very last unit is finished, which could be the entire year of construction loan interest getting capitalized. So that's an election that allows you to increase your basis for tax purposes more than you would get under the normal tax rule. Usually the tax code that dictates this kind of stuff is called 263A, but this 266 election is a way of giving you a little bit more interest to be capitalized for the entire rehab period. Anyway, so the bottom part of this slide is talking about interest. And the reason that we put this here is because of all of the period costs, that by far is usually the biggest one. Property taxes may not be that big, especially if you have a welfare exemption, might be exempt from property tax. Insurance may not be that much, but the interest that goes on during construction is a huge number. And so a lot of time is spent trying to calculate how much of this interest should be capitalized and versus expensed. So GAAP and tax too have this concept of what's called the effective interest method. And the reason we had to do this, or the reason they came up with these rules, is because sometimes loans have strange interest terms where it might even be interest-free during the first few years. Maybe you have some loans where during construction, maybe the lender realized that you wouldn't have any rental activity. So they said, okay, for the first 2 years up until the permanent loan close, this is an interest-free loan. That would be one such arrangement where it's 0% interest for 2 years, and then maybe 5% interest for the next 30 years after that. That's a fairly common scenario. Or maybe there's some type of increasing interest rate. For some reason, the interest rate is 1% and then goes to 2% and then goes to 3%. So anyway, what GAAP says is for any kind of borrowing, you should be trying to match the cost of borrowing against that being the interest. The cost of borrowing is the interest. And that includes things like loan fees that you pay up front. that's part of the cost of borrowing is the loan fee. So whether it's the upfront loan cost or it's the monthly interest that's accruing, you should be trying to match the interest cost with the amount of principal that's outstanding so that you produce a level fixed rate of interest throughout the borrowing period. So the 0% interest really shouldn't exist from a GAAP standpoint. So the way we convert it is we use what's called the effective interest method. So it's an elaborate process where we look at what is the total cost of the borrowing, and then we allocate that to each period so that it produces a level rate of interest. If you've ever bought a house, you've seen the AFR, no, the interest
APR.
APR. That's it, the
Yep.
annual percentage rate interest
Yeah.
disclosure that they have to tell you what is the real cost of this borrowing. And that's the amount, the fixed amount that would be incurred each year that would produce the same amount of interest that you're going to end up paying, even if there's some accelerated payment structure. So the effective interest method seeks to find out what is that APR rate that would give you the same amount of interest over the entire loan term. And then we're trying to match the interest for GAAP standpoint against the amount that's outstanding each period. This is very useful in amortizing loan fees because you may have a large upfront loan fee. And imagine a scenario, this is fairly common as well, where you have a loan that begins being a construction loan, and then it converts to a permanent loan after the construction period is complete. And so the fee associated with that loan, the challenge here is to try and decide how much of that fee should be amortized over the construction period and how much of it relates to the permanent period. Well, if you're lucky, the lender tells you, this is our fee structure for perm loans, this much of it is the perm loan fee, and this is our fee structure for construction loans, and this much is the construction loan fee, and then you can calculate the amortization based on that. But if you're not so lucky, you just have a total fee and you don't really know how to allocate it. Well, in that situation, this effective interest method is used to make sure that we're matching the amortization of the fee with the amount of outstanding borrowings, because the construction borrowings may be much higher than the permanent borrowings because various other sources come in to pay down the construction loan, such as investor capital. So anyway, that's a little bit about the effective interest method. It's also important, the final bullet on this slide is talking about some of the unusual tax interest rules. Very elaborate. We're not going to go into a lot of details here, but just so you know, because these terms, you might hear these terms, OID stands for original issue discount. And this is a tax rule. Well, here in California, we have a lot of loans from our state agency, our state housing agency. They really like 3% simple interest deferred payment loans. And deferred payment loan means you don't have to make any payments if you don't have surplus cash, but based on the waterfall, and we'll talk about all this in another module, waterfalls, but it kind of dictates how cash flow will be shared among various soft debt. These are called soft debts because they don't have a hard payment requirement until maturity. So throughout operations, as cash flow is produced, we pay various debts, including this type of soft debt loan. So here in California, we might have a 3% simple interest, deferred interest loan that's not due until 55 years after construction begins or after the borrowing. So the IRS says they don't think there should be such a thing as a soft debt simple interest loan. So in the IRS's mind, we have to convert this to a compound interest loan. And so the OID calculation takes that 3% deferred payment 55 years and converts that to what is the compound rate that would produce the same amount of interest over the 55-year term. And the answer is 1.79% compound gives you the same ultimate result that 3% simple gives you, assuming there aren't any payments along the way. And so the IRS makes us recharacterize whatever the interest was on the books from 3% back to 1.79%. So you lose some basis when you do the OID calculation because your 3% loan became a 1.79% loan. So that's what OID is all about. AFR stands for the applicable federal rate. And this relates to when you have a seller take back situation. If you're buying property and the seller is taking back some of the loan, meaning the seller has extended a loan to you, the buyer. Well, the terms of that loan are require that the interest rate bear a rate that is at a minimum equal to the applicable federal rate. This is a table that's published every month by the IRS, so it pertains to the month the loan is issued. And so you look up the table and you see, okay, this month for a long-term loan, the minimum rate that the IRS will allow is 3.27%. And so if your seller took back a note on the property for 2%, but the AFR rate is 3.27%, then once again, we have to recharacterize how much was actually borrowed and recharacterize the actual purchase price of the property, land and building, to produce the minimum 3.27% yield rather than the 2% yield that's actually stated in the loan agreement. So AFR is another tricky one that you want to make sure that if you have a seller take back loan, hopefully they've already used the minimum stated rate so that you don't have to go through that conversion calculation.
And the good news is you all should have fabulous tax professionals who can help you through these concepts. They do this all the time, and so it's not really incumbent upon you to handle these calculations, but it is really great for Scott to explain the terminology, because you will hear the terminology, so it's good for you to at least understand. I would say to you that in terms of perm loans, we definitely see some state perm loans with a 0% interest rate and a 55-year maturity. And in those cases, we do disclose the fact that that is market for these types of loans in this type of industry for affordable housing, and we don't have an interest rate adjustment. So don't be surprised if there are 0% loans in your permanent sources and that you do nothing with those, because it's been determined to be market based upon this industry's need for 0% capital to make sure we can provide affordable housing. So it's all about the programmatic mission, which is great to know that you're not dancing through hoops when we're just trying to provide good quality affordable housing.
And the very final words on this slide have to do with Section 266, which I talked about earlier. This is a tax election. It's not mandatory, so you have to make the election by putting a statement on your tax return that says you're making this 266 election. But if you make the election, then it allows you to capitalize interest all the way from the beginning of the rehab period all the way till the end of the rehab period for all of the units. So you're not trying to figure out which units were in service or out of service. You just start with beginning of rehab and capitalize all of that construction loan interest all the way up through the end of rehab. So that's an important election to make, and it helps in other ways too that we'll talk about later on, not just with interest, but it allows you to capitalize a lot of things that otherwise would have to be expensed. And that's important on a 4% deal, because you want the more basis, the better. And the more basis, the more credits. And the more credits, the more investor capital. And the more investor capital, the less deferred developer fee. So you get your developer fee paid faster that way. So it's time for another poll. Looking at the construction costs, which cost would you avoid if you were involved with new construction? Bond fees, inspection, engineering cost, relocation fees. So if you're doing a new construction, which of these costs do you think would not be likely to occur? Do we have answers, results? All right, 96% relocation fees. That's a good answer. You know, the reason is with new construction, you're starting with raw land. So I think if you did have relocation in new construction, it would only be because you bought a property that had a building on it already, and you had to move everyone out before you tore it down. Hopefully you moved them out before you tore it down rather than after. And that would be relocation. But you know, outside of that scenario, in most cases, your new construction, you're buying raw land and working with that. So there is no relocation typically. All right, I'm going to re-engage my slides now. There we go. So this is kind of a catch-all slide talking about a bunch of different concepts that have to do with construction-related accounting. The relocation costs are differing treatment depending on whether tenants are over income or not. The general rule to keep in mind, I think the easiest way that I like to think about it is if you're in a rehab situation, so you're doing temporary relocation during the rehab, then you would capitalize, if you make your 266 election, you can capitalize the relocation costs. The IRS actually came out with a manual that says relocation costs in a rehab deal should be expensed, not capitalized. But I think that if you make your 266 election, that would override that policy that the IRS has. But if you don't have that election, then you would have to expense those relocation costs. So that's another reason why you definitely want to make a 266 election. Permanent relocation costs are usually, now you're talking about tenants who didn't qualify, their income was too high. And so probably when you bought the building, you know, there were over income tenants in there. And so you're doing a permanent relocation cost. Those are typically not eligible for credits. And if another scenario is you bought a building and you're going to tear it down and you have to do the permanent relocation, well, that's all part of the demolition, really, because you're going to end up with raw land. So just like demolition costs, those relocation costs would go into your land basis. They wouldn't even be part of the building. So no credits on that either. Second one here is talking about the developer fee. We saw that on the requisition that Gail was showing us. There's a fairly elaborate calculation of how the developer fee is calculated. There are different percentages on acquisitions versus rehab costs and other criteria, and different states have different limits as well, and how much can be deferred versus how much can be paid up front. So we're not going to go into all of those minute details, but I think the important thing is to understand how to account for developer fees. Probably someone else will be determining when to make the payments of the developer fee, and it is all capitalizable on the books of the entity that has to make the payment. It all goes into either building. I've seen some of it allocated to land in some cases, but most of it goes into the building. And so this sub point about percentage of completion, we're talking here about our new accounting pronouncement, contracts with customers, which became effective last year. The developer fee is such a contract with a customer. So you have one entity, which is your developer sponsor organization that's charging the fee, and the customer is the partnership in this scenario that's buying those services and capitalizing that fee as part of the construction cost. So what we're talking about here is normally under the contracts with customers guidance, which is the new GAAP pronouncement effective in 2020 or 2021, depending on when you chose to enact it. Normally, you would be able to use percentage of completion only in a scenario where the customer controls the asset, which is the building that you're working on, and in this case they do. So the customer, the partnership, owns the building, controls it, and then you're doing development. So that allows you to use this percentage of completion as a revenue recognition methodology which is good. The alternative is what's called the milestone approach, which is kind of what's usually in the developer fee agreement, where cash is released at various milestones. Like you get 30% of your developer fee when you sign the construction loan. You get another 70% when you get the permanent loan closing, and you get the final 30% when the cost certification and 8609 forms are in. So those triggers are really, we look at those as cash release triggers in the contract. But they could also be deemed to be milestones that determine when you earn the fee, if you choose to employ this milestone approach. GAAP usually prefers a percentage of completion approach because it's a better way of matching your revenue and your expenses for developer fee really being mainly salaries of your development staff that the sponsor is incurring. So in order to more properly match the revenue and the expense, you would probably, if you could, you would choose to use this percentage of completion approach to recognize developer fee. But anyway, from the standpoint of the partnership, they're going to capitalize the fee regardless of how you recognize the revenue. But because nowadays most partnerships are being consolidated with developers eventually on the financial statements of the entire enterprise, because you're controlling the partnership, so you're probably going to be consolidating that partnership, you would want similar fee recognition to occur at the similar time so that your consolidated numbers match. Your developer fee receivable on one entity equals your developer fee payable on another entity. And even though one entity has income for the fee and the other entity has a capitalized item for the cost, we can deal with that through elimination entries. But anyway, the timing is you want it to be the same on both entities, payer and the receiver. Construction draws, Gail talked about recording and reconciling those. I think we've covered that already. The fourth one, special tests measuring qualified construction costs as a percentage of bond proceeds. This is really talking about mainly the 50% test. So when you're dealing with acquisition rehab 4% credits, you're probably dealing with tax exempt bonds as a financing source. And in order to pass the 50% test, the sum of all the bonds drawn have to divided by the land and the building eligible basis building costs has to be more than 50%. And the reason for that is because the property has to be primarily funded with tax exempt financing. And that's interpreted to mean more than 50% funded by tax exempt financing, or else you don't get credits on the portion of the property that was not financed by the bonds. So that's an important rule to make sure that you're going to pass the 50% test by borrowing the bond proceeds in the same year that you're going to claim the credits, so that you can say that when you look at the total bond proceeds, you've maximized that, and it's at least more than 50% of the total building cost. I've seen situations where the final draw on the bond didn't occur until the next year, and that was unfortunate because then it jeopardized passing the 50% test, because you don't get to include next year's bond borrowings. You have to look at this year's bond borrowings. So that's a very important test to make sure you're going to pass when it gets close to December 31st.
So the other thing to point out to you all is that when you're doing a 50% test, you want to be as far away from or as far above that as you can be. And if you're close, the first thing that will go is your development fee. They'll remove that cost. So there's a real cash consequence to not making this test. It's incredibly important that you make it. And it's also very important that you make it with a margin of error, because if the IRS was to ever come back over your 15-year period or whatever the period of the debt might be and challenge some of your costs, and you then fall below the 50%, you could have a problem. So it's a critically important test to pass. Everybody cares about it. You won't be the only one thinking about it. Everybody cares very much about this. And if you're close, there will be a discussion about what you need to do to make the test, because it impacts everybody who's on the team. investors and construction folks alike. So it is something that everybody pays attention to. So not on your shoulders, but very, very important.
Okay, we're going to rush through the rest of the slides so we can take our break here. But the interaction with the property manager is a pretty key point. You know, you may have a captive property management company where you're doing your own property management, or you may have a third-party property management, but you're probably starting to sense that there are some deal points that are pretty important to hand off to them when the rental activity starts. They need to know about things like reserve fundings, which lender is asking for how much of reserves, and soft debt. We talked about various fees payable out of surplus cash. They need to know which fees to pay, which are hard debt fees, monthly mortgage, which have to be paid every month, which items are just going to be soft items paid out of the waterfall of surplus cash. So that handoff meeting with the third party or even your internal property management folks is a pretty important time to make sure that all those deal points get communicated appropriately. Rental achievement, break even, we're talking here about once you rent up, there's a process where as you're renting up your units, you're not breaking even yet, but at some point the vacancies tend to go away and you're fully 100% leased up. And when you compare your rental income to your kind of normalized expenses for rental activity, at some point, hopefully you're going to break even and then start producing a profit. And the date that that happens can be significant for certain agreements. Sometimes the guarantee agreements are measured based on when you achieve this, or the developer fee is released, some portion of it, when you achieve this break-even point. Debt service coverage ratios are calculated, you know, starting with when you achieve this. So anyway, it's just a concept to understand that this break-even point is a fairly important time to make sure you and sometimes some agreements will say you need 3 months of break-even operations, and once you've done that, then perhaps one of the guarantees will burn off, so you are not on the hook, although you're probably going to honor these guarantees anyway, even if you aren't on the hook. Tenant file reviews is talking about auditors coming in, looking at tenant files to make sure that the families that are moving in meet the income levels. So on a new construction, we'll always do, or a rehab, we'll always do a certain percentage review of tenant files as part of the annual audit, just to make sure that you're complying with the intent of the program and the people who are moving in are eligible to move in. Some state agencies may do 100% tenant file review, or some investors may require 100% tenant file review, and others you leave it up to the client and the auditor to decide how many tenant files need to be reviewed each year. But you want to make sure that if you are the property manager, that your tenant files contain all of that information about income levels, and that the annual certifications are done as required by your state agencies. First year audit cost certification, final item on this slide. We've talked about it before, but there will be a cost certification audit performed by a CPA at the completion of construction that will do a lot of the allocations and calculations that we've been talking about, categorize the costs by different categories, determine what is the eligible basis. And the first year audit will be your operational audit. Once you have income, your investor will probably want to start seeing audited financial statements, even if your construction is still going on, if it's an AC rehab deal. So your first year audit is a more complicated thing because it's setting up all the footnote disclosures and reading all the agreements, and you can anticipate that that's going to be a little bit more time consuming than the recurring audits that happen thereafter. So I think we're up to our 10-minute break. So it's 19 after the hour. Gail, do we need to shorten this one, or is 10 minutes still going to be good for us? You're on mute.
Yeah, I got it. I think we probably need to do about 5 because we've still got
a ways to go.
Yeah. Mm-hmm.
Okay, let's do 5 minutes. It's 11:19. Why don't we come back at 11? I mean, at 25 after. It may not be 11 where you are, but it's 11 where I am. We'll come back at 25 minutes after the hour. And in the meantime, Gail and I will be here for the most part. If you have questions, please stay and chat with us.
So Scott, I show that we had about 40 minutes left of content, so we should be fine.
Good. Looks like it's 25 after. So I think we can resume. We have a poll. Sophie, can you launch the poll? Is your company currently in the middle of an active development project? Yes or no? And if so, is it a rehab, new construction, or no active projects at this time? This will tell us how pertinent today's topic is to all of you.
Mhm.
Do we have results to share from that poll? Wow, 95% yes. And then kind of split between rehab and new construction.
Yeah, so a couple participants had say that the poll should let them pick both options because a few folks are doing rehab and new construction.
Good point. All right. Sounds like everything we're talking about is timely. All right. All right, just a few more accounting concepts to go over. And then Gail will resume talking about some operational aspects of how all of this works in the real world. So I've been talking about acquisition rehab versus new construction and trying to highlight the fact that theoretically anyway, an acquisition rehab accounting wise should be kind of similar to new construction. It's just that instead of doing the whole building all at once with a new construction on an acquisition rehab, I think of it as each unit being a separate little construction project and try to get to the right result on a unit by unit basis. So clearly that's going to be a very time consuming effort if the units are not taken out of service for very long. So this is kind of a rule of thumb. It's not a written rule or a law or anything, but I use a rule of thumb that if the units are not taken out of service for more than 30 days, probably not worth going through the exercise of trying to allocate some portion of the period costs to building or property equipment to capitalize it, in other words, because it's such a small number anyway, it's less than a month. So for those 2-week rolling rehab things where units are in and out of service for 2 weeks, you know, I tend to just ignore the fact that there probably could have been some interest capitalized for 2 weeks, but it probably just not enough to make it worth the effort of doing the calculation. But having said that, theoretically, even if it's only out of service for 1 day, you know, there should be some interest capitalized. So, you know, if the client said, we think we want every last penny of eligible basis, then it would be hard to say no. You know, you do have to calculate it because there's no reason why it wouldn't be capitalizable if the unit was taken out of service, even if it was for only 1 day. It's just that in the real world, we don't see that. People doing that level of minutia. So the same rule applies for depreciation. You know, if a unit's not in service, it shouldn't be depreciated because, you know, nobody's in there. So if you're taking your units out of service temporarily during a rehab period for several months, you know, you might consider stopping the depreciation for those same months because the unit's really not being used at all.
So Scott, this is a good point, a place to point out that while your development team is fully engaged in doing the development work, they're not thinking about depreciation for you. And so it's really important to be meeting with them monthly to understand what's in and out of service. There's generally a schedule that they keep. They have to know. They have to plan for what will be in and out of service, and they'll track that against the actual. So it's not that they don't have that information, they do, but they're not going to clue you in. So you need to be in touch with them to figure out whether you have a gap accounting issue with regard to depreciation or any other period costs as to whether they should be amortized or not. So just a good reference point there about being engaged.
And the next point has to do with Davis-Bacon, which is a federal act that has to do with making sure that construction workers get the prevailing wage, meaning the pay that goes to the construction workers is fair and it's based on what a union rate of pay would be in your area. And so anytime you're dealing with federal funding, you have to comply with Davis-Bacon and maybe state funding, and some states require that as well. So the recommendation here is that the employees that are working on the building, the construction employees that have to comply with Davis-Bacon, it's best if those are paid by the general contractor, because chances are the general contractor has experience with certified payrolls and doing the type of things they need to do in order to qualify, to make sure and certify that these people were paid the prevailing wage. Whereas if you're hiring people on your own to do it, it's going to be harder to get the certified payroll on your people. And then if they don't qualify under Davis-Bacon, then, well, you may have violated the federal requirement for that particular funding source. Relocation costs, we've talked about that pretty well already, so it may or may not be basis eligible depending on things we said before. And this is an interesting point here at the bottom. The project can claim rehab credits or acquisition and rehab credits, but it cannot claim acquisition credits alone. This is because the whole program of, we're talking about either 4% or 9% really. If you're acquiring a pre-existing property, if you don't do any rehab on it, it's not enough just to buy the property and move on with renting it out. You have to actually incur some rehabilitation costs, and different states have different minimum rehab costs per unit. It might be 20% of the building cost has to be spent on the rehab, or it may be you have a per unit cost, something like $6,000 or $10,000 per unit that your state has established as the minimum rehab costs in order to even participate in the program of getting acquisition rehab dollars. So the point of this is, you'll never get just acquisition credits if you didn't have rehab going along with it. But you may get rehab credits and you may not be eligible for the acquisition piece. But there'll always have to be at least the rehab piece, or else you wouldn't even be involved in this program in the first place. So here we have another poll. Why might your units be out of service longer than anticipated? So this is unanticipated things that could cause your units to be out of service longer. The rehab period might be longer than expected. Was it adverse weather or staffing issues with the construction company, or other non-performance on the part of the construction company, or material delays, or all of the above? What do you think might cause your units to be out of service longer than anticipated? The reason this is important is because interest costs are building up. The construction loan interest I mentioned is usually at a higher rate than the permanent loan interest. And so not only do you not have people renting potentially, so you have no source of income, but you also are paying a higher rate on the construction loan until that thing gets paid off. So the longer the construction drags on, the more costly it becomes. All the more reason why this development sources and uses budget is important, to make sure you have enough sources to fund all of these development costs, including all of that interest all the way up till the permanent loan closes. So most of you said all of the above. That's true. Any one of these really could cause units to be out of service longer than anticipated. I recall in 1989, we had a big major earthquake here in Northern California called the Loma Prieta earthquake, centered around Santa Cruz. And I had a client, which was a developer that specialized in Santa Cruz, and they had 2 or 3 tax credit deals in construction at the time of that earthquake in 1989. And of course, the delays that ensued after that earthquake were quite lengthy, and to the point where the construction really wasn't able to resume for so many months And meanwhile, the interest continued to accrue. And ultimately, as Gail mentioned, when you have these, sometimes these unexpected additional development costs are really going to come out of your developer fee, or at least defer more and more of your developer fee. But there's only so much of the developer fee that you can defer. And at some point, if the interest is so far beyond what you budgeted, it's even more than your developer fee was going to be. You have to defer 100% of your developer fee, and that's still not enough to cover all of these cost overruns. So, the unfortunate result was that developer went out of business. Those properties were handed off to someone else, and years later finished, but the developer itself ceased to exist as a result of that. So that's a pretty tragic result, but a real world situation. All right, let's move on. Operations cash is sometimes a source. So in an acquisition rehab deal, I think we saw in Gail's requisition, operating cash flow was one of the source line items. What that means is that fortunately, the rental income was enough minus the rental expenses to actually produce positive cash flow even during the rehab period. And so normally operating cash flow gets distributed under the terms of the waterfall, which we'll be talking about in a future module. But you could let people know that the development needs that operational cash flow. So you're not going to be distributing it under the terms of the waterfall at all. You're going to be using all of your operational cash flow as just one more cash source to fund your development uses. And that's pretty common. So that's another thing to keep in mind.
Yeah, you should make sure your asset management staff is aware of that, though, because I had that happen on a deal where we started to go over budget in a line item, and the development people said, oh, we'll just use the operating cash, and didn't tell anybody on the asset management side. And we ended up having some cash issues. So again, staying in tune all the way through the project to make sure there are no surprises is just so important.
Yeah, in every audit, we have to include the surplus cash calculation, and as well as how the money's going to be distributed. And so you can imagine if the development team had decided that some of the operational cash flow was going to be used for development sources, and then we turn around on the first year-end audit and show that the operational cash flow is going to be distributed to the third party under the waterfall. Now we've spent the same dollar twice, and that's when you run out of cash. So instead, you would have to have a line item on your surplus cash calculation to show that this much of the operational cash flow was already earmarked for development. And that should tie to the number that's on the cost cert, because there'll be a column for each source, I should say, and one of those sources is the operational cash flow. Anyway, so that's what the first point is about. The second bullet on this slide is talking about related party transfers of property. And here we have a GAAP rule, which is different than tax. So GAAP is trying to make sure that whenever you have controlled entities where you have common control, which is your typical scenario where your sponsor board of directors is also the board of directors on each of your general partners, or at least the majority board is made up of similar people from both organizations. So once the general partner is controlled by your sponsor, that means that the partnership that general partner is a partner in is also a controlled entity, because general partners are deemed to control limited partnerships, because limited partners are deemed not to have any day-to-day type of control or rights. So all of these things get consolidated together, and you don't want GAAP says you don't want a situation where one consolidated entity can transfer property to another consolidated entity and generate a profit. Because heaven forbid, if public companies were able to generate profits that easily by selling products back and forth to their subsidiaries, they could boost their earnings sky high, and the stock market would be totally unreliable. So GAAP says, no, you can't make profit by selling things to yourself. That's not a fair way to make money. So when you have partnership A selling a property to partnership B, if they're both controlled by your same board ultimately, because your general partners are made up of the same board, or at least controlled by the majority of the same board, then you cannot recognize any profit. So what that means is you're bringing over your assets at net book value to the new entity. So, basically you're taking everything off the books of partnership A and putting it onto the books of partnership B, but there's no gain or loss as a result of that. So the fixed assets are transferring, the accumulated depreciation zeroes out, the is taken off the books, by the seller, and loans are transferred over. Whatever the net of all that is an equity entry, so the transferring entity might have a debit or a credit. Could that's the net number could go either way, but the acquiring property will have a equity transaction in the exact same amount, so that when you consolidate these projects together, those transfers zero out, and the building is just the same as it was from a consolidated viewpoint. Nothing happened. It just changed from subsidiary A to subsidiary B ownership wise. Anyway, that's a GAAP concept. For tax purposes, fortunately, because you're looking at tax when it comes to eligible basis calculations. So from a tax standpoint, you respect the sales contract and you book it at the new purchase price, and usually based on an appraisal. So the land in the building is stepped up to the new valuation, and that's what appears in the sales contract, and that's what appears on the tax return, that's what appears on the cost cert, and that's what appears in your eligible basis calculation. So just realize that there'll probably be a book tax difference between your building basis as well as your equity capital because of this type of transaction, and that difference will remain for years to come, forever basically. All right, Gail, back to you.
So just one point to make on that last slide, folks, is that we've had numerous discussions amongst some of our CFO friends over the years about that GAAP rule. And if you happen to have a project that is going to be rehab that you've owned for quite some time, like we have here in Boston, both the former company that I work for and the company I work for now are more than 50 years old. So imagine if you were purchasing property back then. At this point, it's almost fully depreciated. And so when you go to transfer it over to the new company to rehab again, you have virtually no cost basis. You do have the rehab costs to add, they'll be capitalized as part of your building costs, but you really won't have much of an acquisition basis for the building itself, not land, but for the building itself to bring over. And it can make your financial statements look very odd, because the debt and equity coming in on the credit side of the balance sheet are based upon the appraised value of the property, not the historic cost of the property. And so you can have a balance sheet that looks leveraged, so it doesn't look very balanced. It looks like you have a lot more debt relative to the carrying cost of the property. So I would say if it's significant, like it was in my case with a couple of my deals because they were so old, you really end up just looking at the tax return when you're trying to understand the economics of a project and not at the GAAP financial statement. So it's important to understand how much of a difference there is so that you look at the right tool when you're sort of analyzing the economics of your deal. So Scott knows I'm not a big fan of that rule, but it is what it is, and we haven't been able to convince anybody at the FASB differently at this point, so we'll see. Okay, so just some tips, and I think we've gone through them. You need to be reconciling monthly those funders requisitions, even if you're not preparing them. Make sure you reconcile them. I think I told you, if the development folks are doing it, I've seen the development folks submit the same invoice on multiple requisitions, so maybe in April and then again in June, and because they're not reconciling to the GL. I've seen them not requisition, so I'm sure, like lots of you, chasing invoices is a full-time job, because oftentimes those invoices go to the development staff. They have the relationships with various of the vendors, and just trying to get those invoices sometimes is a problem, and you need to develop some type of process to make sure you're getting them in the door. If they're not on the requisition and you're not requisitioning monthly, there's not going to be cash potentially to pay those folks, so you'd have a lot of angry vendors who don't understand that it's not your fault if the invoice is stuck in the development staff person's inbox or email. So really important to be reconciling to make sure you're all on the same page. And then there is something to be said for, I think I explained on our template, and I'd be willing to send it around to everybody. It does show our vendors in our particular deal. There is a tab that shows all of your invoices. And so we have a little trick where instead of starting with a new Excel spreadsheet each time and just putting the invoices in, we actually keep a running tally of invoices. We just hide the prior month's columns and keep adding invoices through. And at the end of the project, you actually can unhide all of the rows, and you have the cost certification documentation that our auditors love to see, which is every single invoice under every category categorized for them so that they can pick a sample of things that they want to take a look at. So that's just one little trick. Other folks have thought about using the job cost system. If you have a job cost system in your GL, that's another effective strategy. If you don't want to go to the level of keeping it in Excel, I think that's a really great use of your software. So I would highly recommend that as well. So I think we're next slide. I think it's a final polling question. So just curious, there's no wrong answer here. Who prepares the funding requisitions in your agency? Is it your accounting department, the real estate development team, a development consultant, or somebody we haven't even thought of? Or maybe you don't know, and that probably would have been a good answer as well. You don't know, because I think we've had that come up before. So if you don't know, you can say none of the above, and we'll assume it's because you don't know, unless you want to put it in the chat. Okay, do we have an answer? Oh, so most folks do know. That's great. That's really great. It means you're engaged with your development folks. Interesting that most of you have your development team preparing the requisition, more so than the accounting department, which is interesting. And again, it doesn't matter as long as you're reconciling every single month. I will say that I've been pretty successful in negotiating to have the accounting department do it and have the development team reviewing it. I think that sets up a nice set of internal controls, but it's really up to you and how you organize that for your organization. I think we're coming to a close. So thanks so very much, everyone, for being with us today. The 2 hours seems to fly by, at least for Scott and I. Goes by very quickly. We really appreciate everybody being engaged and asking questions throughout. It's really great to have you participate, and hopefully we're answering the questions that you have. We're happy to take questions, comments at any time. You can email us, you can stay on the line, we can stay on for a little bit. The next session, we will be talking about cost certifications, which is the process of having your costs audited so you can determine what your tax credit proceeds will be. Very important point, right, to be at, to really kind of understand what your final funding sources are. And then something called Form 8609, that is an IRS form number, but it is where you let the IRS know exactly how many acquisition credits you've issued and exactly how many rehab credits you've issued to your investor. And once the IRS knows that, then your investor is allowed to can take those credits on their tax return. So sometimes, as you can imagine, the timing of that is interesting. And so sometimes the 8609s don't get issued quite as timely, and we hopefully get them in time to make the elections when our investor needs them. So we'll spend another couple of hours talking about that with some good class exercises next time. So thank you so much.
And that'll be pretty much the end of our construction look at the chronological look. And after July 14th, then starting with the July 21st session, we'll be going into more operational topics. And really that'll take us through 15 years of the typical project's life when an investor is in place. And by the end of the 11th week, we will be talking about those issues that relate to year 15, which are things like buyouts and re-syndications, and some which I kind of touched on today a little bit with the transfer of property rules. So anyway, that's what's coming up. We'll see you all next week, and thank you for your attention today. Sophie, I think it's back to you now.